Good morning. I hope you're not too shell-shocked by the month of September. Managing investments during months like this is what makes my hair stand on end. It's been a pretty tough month. And interestingly, if not a bit depressing, but the 29th of September saw the 14th anniversary of the 2008 market crash. And it was the same day that markets reached their lows over the last 2 years, and some markets even reached 2008 lows on that day. In fact, the US market had the biggest fall from a quarterly high on record in the month of September. So some big swings, some big movements. We'll unpack them all during this webinar and then talk about our outlook on the future. Still cautiously optimistic, still think markets will rally into the end of the year. So don't give up hope just yet. So looking at various asset classes, it was a terrible month. In fact, it was the worst month for equities since the COVID crash. Soaring US core inflation and a hawkish Fed drove the dollar to extreme highs, and as a result, all other markets sold off. We saw the US 2-year, 30-year curve inverted by the most since 2000. Oil fell below $85 a barrel for the first time since January. The only real winners were healthcare and gold and dollar cash. But in dollar terms, everything was down. It was just with the dollar giving us some comfort and the rand weakening. The global healthcare funds managed to give a positive return. Gold managed to give a positive return, and then the small positive returns from SA cash and global bonds. Pretty much everything else was down on the month, with China being the worst off there, driven by weakness in its property sector. But we'll go into more details on China as we normally do. We still think that there's a lot of upside in that market. So how did this impact the Sygnia funds for the month of September? Well, you can see there that over the long term, over 1 year at least, value is still the best performer. As interest rates rise, as inflation moves higher, value tends to be the best performing equity sector on a relative basis. And you can see the Sygnia Divi Fund and the Sygnia Berkshire Hathaway funds, both top of the pops out of all of the Sygnia funds, giving decent returns, 20% over 1 year from the Divi Fund, 17% over 1 year from the Berkshire Hathaway Fund. Of 1 month, it's healthcare that is proving to be the most defensive, with a 1.4% return in rands, followed by global cash and rand cash sitting there quite nicely. But let's talk about what happened in the month, because it really was a big month of divergence. Not only were equity markets down massively, but we saw an even bigger divergence in the currency markets. The pound had reached its weakest level since 1985, having lost 20% year to date from its highs. The pullback has been even worse than Brexit, and is the worst since 2008. The euro and the yen similarly have lost incredible amounts of value relative to the dollar. The dollar is looking very expensive. This has been driven not by fundamentals, but by a flight to safety. Even though, ironically, the safety that people run to, the dollar, is giving you negative yields in real terms. After adjusting for inflation, which is still sitting around 8%, you're getting 2% in cash. It's a minus 6% real return that this safe haven is giving you. But you can see there that the value is clearly in other fiat currencies, the yen, the pound, the euro. Yes, they've all got their own issues at the moment, but if you look at the left-hand chart here, you can see that interest rate differentials have been moving in the favor of the euro since mid-August. And if you had to go on short-term interest rate differentials, the euro should be sitting at about 110 to the dollar, not below parity. And on the longer term view, the right-hand chart, which bases its valuations on purchasing power parity, there you can see that the euro dollar should be close to 140, not below parity. So certainly some big divergences, both on short-term price differentials and long-term price differentials, as the dollar gets pushed to really crazy levels, as the fear factor impacts markets, and markets are worried that the Fed is going to be incredibly hawkish and raise rates until the world is pushed into recession. And it does look like that. if you look at it on the face of it, but we don't think that's going to happen. And we'll talk more about that when we get to the US section. But it's not only fiat currencies that have been diverging against the dollar. Gold is its most expensive since 2008 relative to the model, which means relative to real yields and the dollar. The chart on the right there shows the model value of gold. It's basically showing an intrinsic value of gold relative to real US yields. And you can see there that gold should be trading at around $800 an ounce, based on where the dollar is right now and based on where real yields in the US are. So the dollar relative to its model, the most expensive it's been since 2008. So yes, it's fallen 20% from its peak, 21% actually from its peak year to date, but it could have fallen a lot further and it's still looking very, very, very expensive. So it's not just the euro and the yen and other developed market currencies that are diverging from the dollar. Gold is as well. So we think gold remains expensive. But these huge divergences have led to central banks starting to intervene. Markets have pushed too far from fundamentals, and central banks who've caused this issue, well, mainly the Fed, the US Fed, which has caused this issue, and the US Fed has not stepped in, but other central banks around the world are being forced to intervene to try and bring markets closer back to fundamentals. So we had the UK restart quantitative easing, but they haven't even unwound the previous one, but they've now restarted with the Bank of England promising to carry out £100 billion worth of bond buying and on whatever scale is necessary. So some hardcore unlimited QE being unwound by the Bank of England to try and protect the pound. Japan as well has intervened. For the first time in 24 years, the Bank of Japan intervened to buy the yen and sell the dollar, spending $21 billion, 3 trillion yen, making it the country's largest single-day action on record. So some massive interventions by central banks, developed market central banks around the world to try and protect the monetary system and protect their currencies. Similarly, even China is stepping in. They're not doing anything aggressive, but they have issued a verbal warning against currency speculation, and People's Bank of China asked its banks to protect the authority of the yuan's fix. So, you know, that this level, this unprecedented level of intervention by central banks does mean that we can expect some sort of stability in the markets, and certainly the markets have started to recover in the month of October. But this is actually more about what's happening in the US and US data, which has come out in the last 2 days, which has actually been negative. And while bad news is good news, weak data out of the US has helped markets recover. But certainly the softer side of knowing that central banks are there to protect markets and the functioning of markets has helped markets to some extent. Although to get a proper bull rally, we do need the Fed to join China and the Bank of England and Japan. So we had some serious divergences in fiat currencies relative to the dollar. We had some serious divergences in gold relative to the dollar. And we've also seen the same in the crypto space. Ether has now fallen 73% from its November peak. So there really was nowhere to hide. But we've included just a chart on cryptocurrencies this month. Even though we cannot invest into them in South Africa, Sygnia tried to launch its crypto ETF and unfortunately was blocked. And we then tried to launch a distributed ledger ETF, which was investing in companies that created technology that use smart contracts and blockchain technology. But that was also blocked because it was too directly linked to crypto. But it's still important to keep track of what's going on in that market, despite the massive falls. And we've seen NASDAQ making a major move into crypto this month, where they're now offering custody services for both Bitcoin and Ether. We saw Nedbank has launched what it's claiming to be Africa's first metaverse, the Ubuntu tokens, with the Ubuntu currency, which is on the Ether blockchain. And Ether itself seeing a major impact, a major event. It was 7 years in the making, the big merge, it was called. Ether's home to about 3,500 apps, which supports exchanges, supports autonomous organizations, and it supports smart contracts. So what happened? What was this big merge all about? Why is it important? Well, it's very important because it changed the way that Ether works from a proof of work to a proof of stake. And that basically means that you no longer mine Ether coins, you verify them. And why is that really, really important, or why is it positive? It's positive because it means that energy consumption falls by 99%. It's a lot more energy efficient to verify than it is to mine. So that is great. It improves scalability. It makes the coin and tokens far more efficient. However, there's always a loss to any gain, and when you give up energy use, you sacrifice security to some extent. And Ether has become a lot less decentralized, which does mean it's less secure. It does mean it's more open to manipulation. You can see there the chart on the right shows the top 5 Ether validators on that chain, and the biggest one validates nearly 30% of those contracts. So it's certainly more open to manipulation, but at the same time using 99% less energy, which is fantastic. So a big move. We're still very, very, very long way from cryptos becoming mainstream and cryptos entering South Africa at least. But it's good to keep an eye on it, and it's also very interesting to see how crypto markets did not remain unscathed over the month of September. It wasn't only gold and the euro and the pound and the yen, but also Bitcoin and other cryptocurrencies also sold off during the month, as everybody fled to the ultimate dollar safe haven, the US dollar, even though the ultimate safe haven is earning you minus 6% in real terms. It is what it is. Yeah, so that was the big move for the month of September. It was really all about currencies and bond markets, less so about equities, even though equities did have a tough time and did reach new lows year to date. So let's see what's driving markets, what's causing all of this unease and unsettlement. It's actually not really about, funny enough, September wasn't really about Russia and Ukraine and the energy crisis in Europe, despite the Nord Stream pipeline blowing up, and despite energy prices skyrocketing at the beginning of the month. It was more about the Fed. But why? So why wasn't an issue? Why wasn't an issue about Europe? Well, the real reason is that Putin has exhausted his natural gas threats. He choked off natural gas to such an extent at the beginning of the month that prices skyrocketed. But they have since recovered, as firstly, Europe has now achieved its storage benchmarks of 90% and is finding more and more alternative sources for its natural gas. So Putin no longer has this tool at his disposal, and he's had to resort to mobilization, and announced another 300,000 troops have been mobilized, and renewed his nuclear threat to Ukraine, saying this is not a bluff. Sorry, it's a terrible Russian accent, but regardless, that's all he unfortunately has right now is a bluff. But the energy prices in Europe have fallen nearly 50%, and that certainly shows that the EU is calling Russia's bluff. So here you can see the chart on the right, the huge spike in natural gas prices as the Nord Stream pipeline was throttled down to nearly zero. This was before it was damaged in sabotage. Of course, the whole sabotage of Nord Stream does raise some geopolitical risks. That if it was going to be Putin doing this, you would think that he would attack one of the other pipelines, which are now supporting Europe. Norway is already delivering more natural gas to the EU than Russia. So those pipelines are far more important than Nord Stream 1, which at the time was hardly delivering any gas anyway. But as I mentioned, prices have nearly halved, and that's because there are a lot of alternative sources that are entering into Europe. So we've got natural gas coming from Norway, and we've got China set to export 15 million tons of fuel as Beijing strives to boost its economy by raising refinery runs. And then we've also got the fiscal efforts that are being put in place. The EU leadership has introduced a 3-pronged demand reduction plan to reduce inflation and help support growth domestically. Similarly, Germany and other EU countries have introduced a number of vehicles to try and assist with growth and reduce inflation, such as once-off cash payments, subsidies, tax cuts, public transport discounts, and tax breaks to businesses. So all of that has led to Europe being able to muddle through what the crisis that it's going through. And so far, predictions are for a mild winter, and with storage levels at 90%, and with a mild winter predicted, there really should be very, very limited load shedding, if there is any, in Europe throughout the winter. So that is obviously reflected in the price of the natural gas. It's also reflected in the fact that the euro has recovered a bit. And we think that while Europe remains the big wild card in terms of risk, it certainly didn't drive markets to their lows in September. And we think that the markets are really concerned about the Fed, and the Fed causing a global recession. And why are the markets concerned about the Fed? Well, because Powell was once again incredibly hawkish. But that's his job. And as I've said many, many times, the Fed's job is to talk a hawkish game, to talk up interest rate expectations, to talk down inflation expectations, but at the same time allow that, do that to allow him to actually not have to hike interest rates as much. So the talk is always going to be worse than expected, but the actual reality is going to be better than expected. And right now we're in the talking phase. So at the September meeting, they only hiked 75 basis points, which was actually slightly better than expected. There were some economists thinking that the FOMC would hike 100. So the actuality, the reality was better than expected, but the talk was far worse than expected. They raised expectations for another 2 hikes next year. And Powell said that this is the very, very lowest level of what is restrictive right now, and that we must accept a growth recession, which is some sort of oxymoron that only economists and politicians can understand. But he's talking about a growth in employment at the same time as a recession in spending, which cannot last for any length of time. But the important thing is that he has been very, very hawkish. And the hawkish talk is what led markets lower, what led to the huge divergence in currencies, led to the yen weakening, the pound weakening, the euro weakening, gold weakening, the cryptocurrencies weakening. It was and bond yields rising to new highs, all because of that hawkish rhetoric. And at the same time, S&P fell, it reached 25% below its peak as a result of what happened. However, we think that the reality is not going to be as bad as what is being predicted, that the Fed is still talking a meaner game than it is actually going to do. Why? Inflation breadth has improved, firstly. Secondly, inflation expectations are falling, and they're falling from 3.2% to 2.8%. And thirdly, producer price pressures are also easing, as announced by the ISM. So what was the big angst in September? It was because the August shelter number was very bad, shelter inflation. So shelter or rent makes up the largest weight in core CPI, and those rentals had the biggest monthly increase since 1986. So that is a huge, huge number with a big impact, and is why markets were so concerned. And even more concerned because generally a robust labor market, and the US is experiencing a robust labor market, means that this shelter inflation number will probably stay high. Fortunately, there is a silver lining, or at least there's a light at the end of the tunnel. If you look at the chart on the right, this shows the Zillow observed rent, and it tends to lead owners equivalent rent, which is your big input to your inflation, core inflation number, by 6 months. So if that is the case, then it looks like that the shelter or rentals in the core CPI number will start to roll over as well next month, hopefully, or by latest the following month, which will give a lot more comfort to the market. At the same time, we had Biden's Inflation Reduction Act, and that allocated $369 billion to renewables, amongst a whole lot of other mentions to reduce the US fiscal deficit, and to reduce inflation. So a lot of positive on the ground numbers, a lot of positive on the ground Fed actions, with a lot of negative rhetoric. And we think that it's unlikely that rhetoric, well, certainly the Fed doesn't want to have to ever implement that rhetoric. And if there are no wildcards from Europe, and if we do see all these positive signs feed through into the core inflation number, then we have likely seen the worst of the Fed. Now, I have said this before, and I have been wrong, and we certainly got back into our technology and our growth sectors a little bit early, probably a month too early, but those are recovering really this month. And as I said before, we've had 2 negative data points come out so far this month. We had a weak services ISM 2 days ago out of the US, and we had a weak JOLTS number out of the US yesterday. Both of those mean weak growth in the US, which means that the Fed can relax in terms of how much it has to raise rates. Bad news being good news. So on top of some stability in energy prices in Europe, we had 2 pretty bad, and they were way below expectations in terms of the JOLTS number was 10% below expectations. And that slowdown in growth means that the Fed is doing enough to cause a slowdown, and it doesn't need to do too much more. So bottom line, we think that now is not the time to panic. Now is not the time to sell. But we do think that markets can recover into the year end. We certainly have increased our equity exposure. We did it about a week ago, and that position is nicely in the money, but we think we're going to hold on to that a little bit longer, as we think that this bounce, certainly, I'm not saying we're back in the bull market, but we do think this bounce could last a little bit longer. Back to China. So China was the disappointment last month. It was the worst performer on the back of the property sector. But again, if you look at what's happening on the ground, things are looking really, really positive there. And China remains roughly 18 months ahead of the economic cycle. So yes, property is weak. There's no denying that. But it crashed 18 months ago, and a lot of support's already being put in place, and more support is coming. Meanwhile, we're still expecting a crash in developed market property, which I'll talk about in a few slides' time, and that will then cause a slowdown in other markets. So we prefer to be in China, which remains ahead of the curve and is enjoying falling inflation, falling interest rates, and growing government monetary and fiscal support. And yes, while some political risks do remain, and we did see Xi meet with Putin this month, we actually think that those risks are receding somewhat. So certainly, if you look what's happening, or what's coming out of India, Turkey, and China, all 3 governments are distancing themselves slightly from Russia. They're not quite as enthusiastic about their support as they were 6 months ago, and we think that political risk is decreasing, not increasing. But anyway, looking on the ground, the chart on the right shows the China credit and fiscal impulse in yellow, and it continues to bounce very nicely. And more importantly, the BCA model suggests that that's going to continue to bounce very aggressively, which should support, if you look at the orange line, the euro, that should support global growth, which should support the euro, which again will support risk assets, and is why we think that the dollar is overbought right now and risk assets are oversold. In August, we also saw August being the most recent industrial production numbers, the most recent retail numbers, and the most recent fixed asset investment numbers, all beating expectations and all looking quite robust. And then very, very importantly, a number that we've been watching and worried about in China, youth unemployment, which had reached a record high in July, or previously July, has started to roll over and recede. This has certainly been a focus about the government. The government is very, very concerned about youth unemployment, and is why they have changed their outlook from worrying about a number of things to focusing on growth in particular. And that is certainly starting to come through. Growth is the focus, job creation is the focus, and that is being realized in lower youth unemployment for July. Infrastructure investment continues to accelerate, and everything is looking pretty positive on the ground for a continued bounce from China. Yes, it's not easy going right now. The zero COVID policy and the property slump have certainly hurt growth, but all signs on the ground point to a recovery. Energy usage has recovered, rail usage has recovered, everything looks like it's bouncing. So we continue to be overweight China and emerging markets. This slide I talked about last month, just talking about Bank of Canada's deputy governor saying, or warning about real estate investments destabilizing the economy, and that we've already started to see. If you look at what's happening in August numbers, chart here shows the property slump has begun. So Australian home prices in particular saw the biggest fall in 4 decades, biggest fall since 1983, falling 1.6% in the month of August. And rising interest rates are likely to lead to further falls in property prices, creating a headwind to economies, particularly Australia and Spain and the UK and Canada. And that's because those countries have the largest exposure to variable loans, i.e. loans which fluctuate with short-term interest rates. And as short-term rates are being pushed up, so those loans are going to see incredible hardships being placed on the holders of those loans. In fact, Canada had nearly 60% of new home loans in 2021 being variable. And that's going to be very, very, very tricky for the housing market in those countries. The US is relatively insulated with a larger proportion of fixed mortgages, but even there, they're going to see some housing pressure just as new buyers face more expensive funding. But generally, we don't hold any Australia, we don't have any Canada. We're avoiding those countries right now in our global portfolios. We do think that this property slump is going to have a negative wealth effect, which will then impact retail spending, and the economies will slow down to some extent. So preferring China, which is ahead of this property burst and bubble burst. Moving on to South Africa, we have Deputy President David Mabuza saying the same as last month, not a desirable state of affairs. Well, that's, I think, putting it mildly when it comes to load shedding. The chart here on the right was done on the 19th September. This is now old hat compared to what we've been through. We're at the worst load shedding on record in South Africa. The grid nearly breached stage 6 last month, and we're still sitting in load shedding. It doesn't seem to be going away anytime soon. In fact, just as you're starting to see some sort of glimpse of light in the tunnel last night, we reverted back to stage 4. Yes, the Eskom is finally making some strides in the short term. They've appointed 12 new board members. They've agreed to buy 1,000 megawatts from private companies. They've hired 18 former Eskom employees with lifetime experience to try and assist. And hopefully these will all have an impact, but they're not going to have impact anytime soon. And right now the country is reeling from a massive growth slowdown as load shedding keeps factories closed, keeps people unemployed, keeps people from spending. It's really the worst example of self-sabotage I've ever seen of a country. It's terrible. Meanwhile, Eskom is still trying to demand a 32% increase in the cost of electricity. Yes, pay 32% more for what you're not receiving, but it's understandable because all their coal plants are not operational. They're running their diesel generators flat out. Those diesel generators are only supposed to be for emergencies and peak periods. They're running 24 hours a day. They're burning through way more diesel than is budgeted for. And as a result, Eskom debt rose to new highs of 413 million as they keep spending vast amounts of money on diesel. And obviously the higher oil prices and weak rand have not helped that at all. Meanwhile, I suppose the only silver lining for South Africa is that core inflation fell 4.4% as growth remains so weak on the back of load shedding that there just isn't enough demand to push inflation higher. We've also, consumers are not only being hit by load shedding, but also by high interest rates. And the SARB, in a very hawkish manner, raised rates by 75 basis points to 6.25%. That despite core inflation falling, despite growth being incredibly weak, and despite the fact that their own models only forecast interest rates to be at that level in more than 12 months' time. Their model only predicts 6.25%, which is where we're sitting at the end of 2023. But their concern is that the weak rand, and the rand is currently very weak, the weak rand will lead to higher import inflation, particularly through oil, that will push up headline inflation. And as a result, they want to try and be ahead of that curve and keep inflation expectations anchored. But it does mean the consumer is seeing more headwinds from higher energy prices, headwinds from load shedding, and headwinds from higher interest rates. So it's all looking pretty gloomy on the consumer side. And when it comes to the industrial side, well, their companies haven't got any power to do anything. And that was reflected in the trade surplus, which fell way below expectations as load shedding impacts what we can export. The only, again, silver lining is that because inflation remains relatively muted on the core side, bonds are giving very decent real yields and will continue to give very high real yields, close to the highest in the world. And that's why we remain overweight South African bonds with a pretty decent real yield coming through there, probably only second to Brazil right now in terms of real yields around the world. Certainly, I'd rather have 4 or 5% real yield in South Africa than minus something in the developed market, which is looking a lot leaner. Okay, so that brings us to our positioning. Growth is certainly slowing down. OECD downgraded its global economic outlook for 2023 from 2.8% growth to 2.2% growth, but that's not a recession. It's actually it is slightly below trend, but it's not recessionary. And we do think that that markets will recover. Growth isn't recessionary. We've still got some of the COVID inflation impacts, which are still feeding through as a deflationary factor, and that will help inflation unwind pretty quickly towards the end of this year. Yes, patience is required, but there are great opportunities. Markets are being driven by fear, not by fundamentals right now. We've got still resilient underlying growth in the economy. We've got very risk-averse positioning. Most importantly, we've got anchored long-term inflation expectations, which will allow central banks to not panic, and those should see markets recover. So the chart on the right here just shows how bearish investors are right now. You can see there, we're as bearish as we were in 2020, and as bearish as we were in 2008. In fact, the only time that markets were more bearish was in 2011. So certainly markets and investors aren't positioned for a bounce. Everyone's consensus is negative, and we think that in the short term markets are oversold. So we remain our positioning in terms of select growth technology exposure, and that's our fourth industrial revolution. And going forward, it will be next week with the launch of our sustainable economy fund. That'll be added to our select growth exposure, select commodity exposure. That will be commodities that are, again, benefit from ESG spending and decarbonization. Overweight value, that continues to work very, very nicely. Overweight healthcare, that also continues to work very, very nicely, as those two themes work with rising interest rates and rising inflation. Generally, we stick to all our long-term global investment themes: rising Asian emerging middle class, aging populations, disruptive technology, and economic sustainability. Those are all important long-term themes. And as I mentioned before, overweight SA bonds. Of course, that means we have to be underweight something. You can't be underweight nothing. We're underweight cash, we're underweight SA equities, and we're underweight global bonds. And finally, we're also underweight US equities. So why are we underweight cash? Well, we do think that markets are oversold, so we want to be overweight risk. We also think that cash is not giving the yields that bonds are, so that's why we like South African bonds relative to cash. Globally, we think that global bonds still have huge headwinds, that interest rates will continue to rise, and the long end will continue to rise. So we don't have, even though value is starting to emerge, we don't have any global bonds. Similarly, no gold. And then US equities. Why are we underweight US equities? I think for two reasons. The two big headwinds for US equities. One is the dollar, which is incredibly strong and will weaken, which will obviously translate into lower US equity returns. And two, it's US profit margins. US profit margins are at 60-year highs. and that's not sustainable. So as those mean revert, and that it's been driven by a very, very narrow sector. So only the tech sector has driven those profit margins to all-time highs, very concentrated and only a couple of stocks. And as the antitrust issues, legislation comes through, and as those oligopolies are broken up, and as competition improves in the US, we're going to see lower margins come through in those businesses. And we've already seen huge corrections happen in some of them, like Facebook and Netflix, and we're likely to see it in some of the other big US names in the top 5. Certainly, there's a risk from Tesla as Elon Musk focuses now on Twitter, with that bid being renewed, and we see some margin risk within Apple, particularly on the competition front. And likewise, Google also facing some antitrust issues as those platform companies being forced to break up. So we remain underweight US equities, which is funding all our overweights in this portfolio. Yeah, that brings our positioning to a close. You all know this chart very well. Our 5 themes: overweight value, overweight sustainable economies, overweight disruptive technologies, overweight emerging Asia, and overweight health innovations. Okay, that is a wrap for today. Let's go to some questions. Yeah, sure. It's going to be a very short session today. We only have 3 questions. Please, if you have any questions, send them through. Last question was received at 11:26. Don't know if that's a tech issue or just there aren't any interesting questions to come through. Books asks, Carl, can you please shed some light on Sygnia, SygCN? That's our China ETF. I'm waiting to invest, but it seems China is struggling. So yes, great question. China is certainly struggling, just definitely from a price perspective. But we did see a nice recovery last night with MSCI China up nearly 5% overnight. What's interesting, what brings me comfort, if you look at the short-term relative, so China versus the US, over the last 3, 6, and 9 months, China is still accelerating relative to the US. Yes, over 12 months, China is still down, but we're starting to see that relative price action change to support China. So we think that the markets are starting to reward a positive China story. And as I've mentioned, there are a number of reasons why, from an economic perspective, China should see relative faster growth going forward than the rest of the world. The rest of the world is going to see growth choked by rising interest rates and rising inflation. China has got falling interest rates, falling inflation, and increasing fiscal spend, where again, the rest of the world is seeing decreasing fiscal support. So all of the headwinds are aligned in terms of against developed markets, and all of the tailwinds are aligned for China. So yeah, it might take a little bit longer for markets to properly turn that into some price action, but certainly the short-term price action, 3, 6, and 9 months, is suggesting that the China story is not broken, and that there is a recovery that is on the way, underway in China. Another question on the gold price. So you saw my gold chart. We've been bearish gold because it is very much linked to developed market bonds. Gold is basically an alternative to your safe havens. So if you want a safe haven, you either buy US bonds or you buy gold. When US bonds have very high yields, well, you'd rather buy US bonds because then you get at least an income, or at least that's the case when inflation is in check. I must admit, when inflation is not in check, it's a bit of an issue, but long-term inflation forecasts in the US are currently in check. It's only the short-term inflation that is out of check. So when US yields in real terms, like 10-year real yields are positive, which they are right now, you'd rather have positive 10-year real yields than gold. When you're getting negative yields out of bonds, or then you'd rather buy gold. And that playoff is what drove gold way past its purchasing power parity basis. So you can see, if you look at the model that I showed, gold should be right now, based on where US real yields are, gold should be trading closer to $800 an ounce. I don't think it's going to get that close, just because we're never going to get back to the old way of fully unwinding QE. We saw that now when markets start to really panic, central banks step back into the QE. So I don't think we're ever going to fully unwind QE. QE is with us for probably forever, which means gold prices aren't going to revert back to $800 an ounce. They're still going to be supported by QE, but at the same time, that QE influence makes me concerned about gold, because you can't really, it is basically expensive on a fundamental basis, but it is also still a safe haven. So yeah, mixed view on gold, but we don't hold any gold, I think, is the important thing. Mervyn asks, Mervyn asked about performance fees and management fees impacting large fund managers. And he says that the Skeleton Balance Fund has a large portion of 91. That's not the case. Our Skeleton Balanced range is purely passive. It has exposure to our global themes, our passive global themes, and all our thematic investments are passive. Yes, it's an active theme in that we invest in China or healthcare or disruptive technology, but all that's done through tracking passive indices that track those themes. So the Skeleton Balanced range is purely passive. Yes, again, it's got active TAA and risk management, but that is done in-house by Sygnia. There's no external managers, and the Skeleton Balanced Fund has no performance fees. The Skeleton Balanced, that range is 35 basis points plus VAT, no performance fees, no external managers. If you want to look at funds that have external managers, and then you need to look at our signature range on the institutional side, or the CPI plus range on the retail side. But even then, we have about 60% passive, 40% active to keep the fees low. And that is Sygnia's entire value proposition. It's all about keeping the cost of those funds low to ensure that your performance after costs on a net basis is good. And if you must have a look at the CPI funds since inception, even though they've got a small allocation to active, they are third, fourth, and fifth out of probably 80, 90, and 100 funds since inception. So that's just showing the amazing impact of low fees. Skeleton Balance range is also similarly top 5 out of 100 for the 3 funds since inception over the last 7 years. Again, because of low fees. So yeah, I think you're wise to highlight the impact of fees. And if you want to see that on a real basis, look at our Skeleton Balanced range of unit trusts, net of fees. Unit trusts are net of fees. Look at our CPI range of funds, which are net of fees, all close to top of their relative sections in the unit trust categories. Warren asks about commenting on Turkey. Actually, I don't have a strong view on Turkey. The only thing that always I find amazing on Turkey is that their growth, GDP growth, has been very strong in dollar terms, much stronger than South Africa, but their currency has been abysmal. Their currency has depreciated massively, and I presume that means that they're quite comfortable taking on a depreciating currency to drive relative to growth. So there are some benefits to that. There are some schools, economic schools, that say yes, when you are not competitive like South Africa, when you've got high unit labor costs like South Africa, when you've got strong unionization like South Africa, and you've got high energy prices like South Africa, well, what do? Weaken your currency, which drives growth. Turkey has certainly embraced that massively, and it has. Their standard of living has risen faster than South Africa. Their GDP is driven faster than South Africa. Their currency is very weak. So as someone who lives in Turkey, you are much poorer relative to the rest of the world. So it all depends on how you look at it in terms of your wealth, and it's definitely a different impact. But certainly, if you imagine South Africa going the route of Turkey to support economic growth, you want to try and have as much money offshore as possible, or at least in equities, South African equities, but you would want to avoid cash and bonds. I don't think South Africa is going that way. We have a very, very hawkish central bank. Carl asks, with bond yields so high, why are the bond fund returns so muted? I think it's very important to unpack that. We have the Sygnia income maximizer, which is currently giving a yield of about 11%. And that's very important for income funds. So if you don't need to access your capital, if you just want to live off your income, you don't mind about capital volatility. And the income maximizer right now is probably 80% bonds. So if you've got your capital set aside, you don't need to draw down that capital, or you hopefully get 11% yield, which is fantastic. It makes living annuities very competitive to standard annuities. A lot of people are avoiding living annuities right now because the yields are so low, but that's not the case. If you can get a living annuity that invests in income maximizer or bonds, you get a very, very decent income. You just got to make sure that you don't draw down more income than that 11%, because the capital values are fluctuating. So over the last year, your total return is probably close to zero. You've had a 10% loss in capital because of high interest rates, and you've had 11% return from income, so your return might be about +1. That's fine. You don't mind about capital fluctuations as long as you're only drawing 11%. If, on the other hand, you actually are living off your capital, well, then you need to be in money market, because you want capital stability. So it's all about where your money is, what you need. If you only need income, then it's great to have as high income as possible, and you can celebrate because you can get 11% income right now, but you mustn't touch that capital. Because your total returns are certainly muted right now with rising interest rates. Again, our base case is definitely over the next 12 months. And yes, our base case has been delayed by the horrible US core CPI number that happened in September, the August CPI number. But our base case is still close on 20% return out of bonds next year on a total return basis. We're still only forecasting 11% yield on bonds, but the minus 10% capital loss should revert to a plus 10% capital gain, giving you a total return of about 20%. But again, that's not something that if you're in a living annuity that you should bank on. If you're in a living annuity, you bank on your yield, which is 11%. And that's a much better yield than you will get in your traditional annuity. So rather invest in a living annuity, match the bonds, don't pay the high fees that you do in traditional annuities in terms of matching and economic costs, and just get that straight yield and much better outcome. Or at least blend it. Blend some traditional with some annuity with a living annuity. David asks, amongst all the Sygnia funds, which will offer the best opportunities for growth in the medium term? Unfortunately, if you look back at our last slide, core satellite investing in a low growth environment, roughly all our themes are equally weighted. The only theme that we slightly overweight right now is China. So I suppose in the medium term, I do think that China's got the biggest upside. It's also got the most volatility. So on a risk-adjusted basis, maybe it's probably not, it's only slightly better than the other ones. But we've got a very, very well-balanced basket right now. Even though we've got a higher allocation to China, it's only slightly higher. So right now, no strong views on any of our 5 themes, like sustainable economy, like disruptive technologies, like emerging Asia, like health, like value. So diversify would be my answer. Shane asks, within emerging markets, are you preferring India to China or vice versa? That is a great question. We still don't think India is large enough to see as a standalone investment. We don't, yes, while our competitors offer a standalone India ETF, we think it's still early to offer direct India exposure. India has got some liquidity issues and some access issues. And in terms of its market diversification, we also don't think it's mature enough to have a standalone India ETF. So we like to blend India with the rest of emerging markets, and we prefer emerging Asia. So certainly we are overweight emerging Asia, but we like to take our emerging market exposure through China and then non-China emerging Asia. And we like both of those right now. Victor asks, are the rumors about Credit Suisse just that? Well, that's a fantastic question. I don't think anyone knows. If you have to look at what the credit default swaps are saying, Credit Suisse is pretty much bankrupt. Certainly, I hope that's not the case. Credit Suisse is a lot more of a bank than Lehman Brothers was. So I also think that it's inappropriate to compare Credit Suisse to Lehman Brothers. Lehman Brothers was very much a corporate merchant bank, very much institutional focused. Credit Suisse does have the retail side and is more diversified. So I don't think the risks are comparable. But I must say I'm not an expert on that and exactly what is happening there. Certainly something we're keeping our eye on, but yeah, don't think it's then we don't think it's another Lehman Brothers. Wayne asked your thoughts on active managers outperforming passive managers in the current volatile climate. Wayne, that's also another excellent question. I suppose we're a bit of a Switzerland when it comes to that. We offer both passive only, skeleton balanced funds and skeleton funds, and funds that include some active, being Sygnia and our CPI funds on unit trusts. Even our synergy range, which is about 70% active, which is our most active range, still has some passive on the global side. So, we certainly believe that the best answer is a mix of active and passive, and that it's best to blend your risk budget. So spend some risk budget on asset allocation and some risk budget on equity alpha and some risk budget on credit alpha. And that's why even our skeleton balanced, which is a passive fund, has active credit in it. So probably something I should have mentioned earlier. Right now, over the last year, certainly active equity managers are doing quite well. So, longer term, 5 years, active equity managers have a shocking return profile against benchmark. Over the last year, the Sygnia's active equity managers in our signature range have outperformed their benchmark by 3%. Some of that is just fantastic manager selection by Sygnia, obviously. A lot of it is the fact that active managers are doing very well of volatility and are adding value. So yes, all I can say is over the last 12 months, active equity managers have done quite well. Active bond managers continue to get it wrong when it comes to duration calls. Everyone keeps thinking that the yield curve is as steep as it can be, and that's not the case. But that's it's possible to say what the short-term active performance of managers is going to be relative to benchmark over the next 12 months. Hello, William. David asked, I'm confused by the choice of funds. How do I narrow down my choices? David, if you're concerned about choice, the best thing, I keep saying, I have 100% of my retirement savings in skeleton balance 70. Skeleton balance 70, 35 basis points, passive exposure to equities, but it's got active credit. It's got active risk management from a tactical asset allocation perspective. It's got exposure to all our global geographic themes, healthcare, value. It's got basically everything at an amazing 35 basis points. So that's if you're confused about choice, that is the answer. If you like choice, well, then you can use that as a core and you can add on some of our themes, whichever theme you like the most. Or if you only want global equities, then you can go for the skeleton global equity fund of funds. That's a 100% global equity fund. And that tracks our house view in terms of our themes. So it's got a core of passive, and then it's got the same theme allocation as all our global funds. So those would be my choices. Skeleton balance 70, or the skeleton balance range, 40, 50, 60, 70, depending on how much equities you want, or skeleton global equity funds if you want 100% equity. Kate, all our Sygnia funds have the same positioning. So we have one house view when it comes to being overweight equities, underweight equities. We have one house view when it comes to our allocation to our themes. Basically, we do everything on building blocks to make sure we have massive economies of scale and that we have as little trading as possible. All our funds have exposure to the same views. The only thing we do is we scale back on the risk budget. So some have slightly more equities, some have slightly more tactical asset allocation, and some have less. And generally, the higher the equity, which means the higher the equity volatility and higher the equity risk, means we do more risk, less risk budgeting, more tactical asset allocation to match that extra risk budget that is allowed. Great question on the US Inflation Reduction Act. Will it actually reduce inflation when it has billions in spending and savings? I think you're spot on there. I think that the Inflation Reduction Act is at best going to be neutral on inflation. I think the rhetoric is certainly positive. I think what's happened is that the Democrats have used inflation reduction as a scapegoat to try and get through some of what they want in terms of forgiveness of student debt, in terms of supporting renewables. So they've all said kind of, this is what we want to do. Let's call it inflation reduction so that it gets approved, but it's probably going to be neutral to inflation. Yeah, certainly not a big part of our view in terms of inflation coming down in the US. The US fiscal deficit is still massive. That said, that impacts longer term inflation in the US. Short term inflation we think is still going to come down in the US. Ben asks, has our view changed on crypto from being cautious? No, Ben, we're still cautious on crypto. We did want to offer the funds because we think it's important that people have access to crypto if they need it, particularly although we're cautious on actual investing in the cryptocurrency itself, whether it's Bitcoin or Ether or any number of them. We thought that the ETF that we were trying to launch, which invested in companies that use technology that is based off distributed ledger technology, we thought that could actually benefit the most in the long term, and that's pretty much focused on the technologies that are using the Ether framework. But we still are cautious. We still think there's too much volatility, and right now you can't invest in it from a South African perspective. That said, there is a small allocation to distributed ledger in the fourth industrial revolution. So you do get exposure to that in our fourth hour fund. It is one of the disruptive technologies within the fourth industrial revolution fund, and so that you do still have some exposure to it there on a blended basis. And I think that's probably the best way to go right now. Blend that theme with the other 26 themes that fourth hour fund has to reduce the volatility. And because right now we don't know who the winners are going to be. It's that technology, Web 3.0 has fantastic upside, very exciting, basically decentralizing the internet and allowing a far more entrepreneurial web. It's very exciting, but it's very, very early days. So best to be diversified. In the same way that we are very excited, something that's probably equally early but very exciting is genetic engineering or genomics. We think there's massive upside to that technology, and yet we've still got in our health innovation fund, we've still got about a 7% allocation to that theme. We still think that although there's huge upside, there's also a lot of volatility. Karina, South Africans aren't allowed to invest in Bitcoin in South Africa due to legislation. South African legislation. If you have your money offshore, if you have dollars offshore, and you're not impacted by South African regulations, then you can do as per global regulations. Or ask the view on the Rand dollar. So I can't find my crystal ball, but our short-term view is that the Rand is oversold. mostly because the dollar is too strong. So, the dollar at 40-year highs, yes, the dollar is very momentum driven. Yes, it's hard to call it the top, but it is very stretched, and we certainly think that as some sort of fundamental valuation and some sort of normality comes back into it, maybe in the next 3 to 6 months, the rand will be stronger as the dollar weakens. And we are seeing that come through, at least in a little bit over the last few days, driven by some weak GDP, weak economic growth in the US. Good question on our emerging market funds. Emerging market ETF has 6 Russian exposures, which have been written down to 0. There's certainly a non-zero probability that over the next decade, there is some value. I mean, right now, those holdings have got positive, those shares have positive value in the Russian exchange. Unfortunately, they've got 0 in where they're listed in the UK. If those shares get moved from the London UK exchange to the Russian exchange, and if regulations allow that investment to follow, then there is some upside. So certainly a non-zero probability of some upside there. Basically, when it's a free option. Great question about whether SA bonds are a safe haven for long-term investing. I think for long-term investing, you need to be diversified. You wouldn't want to have everything in one basket, but as part of that diversified basket, SA bonds giving you 11% yield, that is fantastic. I mean, if you look back at what equities have done over the long term, if you look at our forecast for equities going forward, when you've got SA bonds giving you a real return of close to 5%, you're not expecting much better from South African equities than a return of 5%. So it's certainly very useful to have SA bonds as part of our diversified basket for long-term investing. Again, it boils down to a tax issue. You do obviously pay it's income tax because it's interest income. So I would certainly include it in tax-efficient vehicles, but I wouldn't include it in discretionary vehicles where you pay high taxes, or at least I would have a lower allocation when you're paying high tax. So it comes down to what tax vehicles you have and what allocations you can have to tax-free savings accounts, retirement annuities, and discretionary money. Jean says, a bit confusing that you're anticipating Chinese real estate growth. Possibly I misspoke. I do tend to babble. Bottom, and the bottoming of that sector due to government support will allow the rest of the economy to recover. It's still going to be a headwind. It's definitely a headwind, and it's going to be a headwind for a while in China. But I think there's enough other support that other sectors. So basically, real estate, and particularly property development within the real estate sector, is very good for driving growth. We're going to see a move away from property development within real estate to infrastructure. So there will still be a lot of property development, but they'll be building roads and bridges and hospitals, not building houses. So that's the fact. That's what I'm trying to say, is that sector of the economy is going to be supported by a shift into government-supported sectors, infrastructure, but the real estate sector is still going to see headwinds, and it's probably going to, at best, just bottom. But the drag that it's causing will be made up in other parts of the Chinese economy. Clement asked if I expect resources stocks to do well in the long term. In the long term, I'm a very big resource bear. And that's just because if you look at resources over the long term, over the last 100 years, resources don't give you a great return in real prices. They are literally the definition of a commodity. A commodity is when you're a price taker, not a price maker. So resource stocks aren't something you want to hold for the long term. That said, there are definitely times in the short term you want to hold them. And right now, we do think that resource stocks are exposed to decarbonization, and that's things like lithium from batteries, copper from electric vehicles. those will all see some short to medium term support, but long term, I'm pretty much a resource bear. I think that resources give you a lot more volatility than financials and industrials, and even resource companies. We look at the sector performance in the long term, going back as far as you can in South Africa. The Resi has given you the worst performance on an absolute sense compared to financials and industrials, and on an absolute, on a risk-adjusted basis, an even worse performance. So yeah, I'm not a big resource fan in the long term. The UK was seen as a recovery situation. Has the last mini budget crisis changed this view? So when I said that South Africa is probably the worst example of self-sabotage I've ever seen, I misspoke. The UK is the worst example of self-sabotage I've ever seen. In fact, the pound has performed far worse than the rand over the last 3 years. If you look at just prior to Brexit, the pound is weaker than the rand. I mean, it's to do worse than the rand. You really have to be yeah. So a lot of own goals, a lot of self-sabotage that's happening in the UK. A lot of I think trial by error, it looks like. So yes, the UK put out a terrible forecast in terms of cutting the tax rate and ballooning the debt, and as a result, the pound just collapsed overnight, and we nearly had a run on the pound, and all sorts of. And that's why we had to have QE just to save the UK pension funds. But fortunately, the politicians have Truss in particular has reversed that move, and everyone's pointed fingers at everybody else, and we've got a more reasonable budget coming through. So I suppose the UK may be learning faster than South Africa, and that they learn from the mistakes, but at the same time they also seem to be a bit clueless in terms of what they are doing. In terms of the pound, on a purchasing power parity basis, the pound is looking incredibly cheap. That pound is pricing in a lot of risk, but it's understandable right now. There's a lot of risk, a lot of political risk, a lot of turmoil. You have to think the base case is that the pound will recover, and that as we've seen in the latest mini budget, which is actually relatively reasonable, that will that the markets will drive some sort of reasonable budget, and the economy will recover. EJ asks why rising interest rates in South Africa are not reflecting in our money market funds. They are. Certainly, if you look at the yields, I didn't have that slide in this month, but money market yields are close on 7.5%. Our enhanced income fund is nearly 9%. Our income maximizer is over 10%, and bond yields are nearly or over 11%. So as interest rates are going up, certainly the yields are rising. So yes, 12-month 1-year returns don't reflect it, because that's historical. That's looking back. Look at 12-month returns on any of those funds, it's reflective of lower yields. But if you look at current running yields, which includes the fact that the repo rate is 6.25%, you're looking at fantastic yields on cash, fantastic yields on enhanced income credit, fantastic yields on income maximizer, fantastic yields on bonds. So those are starting for the first time since pre-COVID. All those asset classes are actually starting to look very attractive versus SA equities. And it's another reason why we're very comfortable being overweight SA bonds and underweight SA equities, because they're getting some very juicy yields. And as I mentioned earlier, if bonds are giving you a real return of nearly 5%, if credit's giving you a real return of 3%, that's compared to equities of maybe 6%, but a lot more volatile. You certainly have to have some credit and some bonds in a balanced portfolio, and that's how we do. Skeleton balance 70, allocation to credit, allocation to bonds, allocation to equities. Shane then asks, that leads into Shane's question. How has the SA property sector performed, and what is the outlook in the short to medium term? It has performed poorly. It remains a non-core holding in our funds. We don't have any in our enhanced income fund. We don't have any in our balanced funds. Obviously, there is some property in the SWIX, so you do get some indirect exposure just by holding SA equities, but we're still very bearish on SA property, and we're very bearish on in the short and medium term. Yes, some decent yields, but there's still growing debt in that sector, and more importantly, rising interest rates will cause a headwind because of the debt. All those companies, property companies, all those rates are geared, 40-60% debt, and that debt servicing cost will go up as rates go up, and that will be a headwind to earnings. On top of the fact that you've got to still have a supply demand imbalance, which will be a headwind but the price has recovered to reflect that. Dita, I'm not sure when our new website is going to be available. David asks, and I think David, that's a fantastic question. Is it a good idea to switch one portfolio to low equity exposure due to the short-term outlook, even though you have to crystallize capital losses in the current equity drawdown? David, I would say definitely not. Definitely not. If you need money in the short term and you're forced to liquidate, then you are forced to liquidate. But I would not lock in losses right now. What I can tell you, we don't know. The market could be lower in 6 months' time. The market could even be lower in 12 months' time. But the market is definitely going to, market's 95% probability the market will be higher in 3 years' time. So if you are going to crystallize a loss, make sure you have a very, very good re-entry point. So if you are watching the market every day and you're convinced the market's going to be lower, then only do it if you say, fine, I'm going to sell today, I'm going to lock in a loss because I'm convinced the market's going to fall. I'm going to buy back in after it falls 5%. Or I'm going to buy back in after it falls 10%. And if it doesn't reach that level, then make sure you have a very, very good stop loss. So that, well, if it only falls 3% and I don't buy in, and it starts rallying, and it then rallies 10% above where I sold, where's your stop loss? Where do you get back in? So I would only do that if you have, I'd only crystallize a loss and sell at a loss and de-risk your portfolio, unless you're forced to. I'd only do it if you have a very, very good re-entry point and a very, very good stop loss point. It's something that we do from our perspective, in terms of we do sometimes cut positions when the facts change and we move into other positions, but we're watching it every day. And we have a lot of ability to diversify, to balance risks, and to manage those points. And also we can do it through it. So we can close our positions at very low cost, and if a stop loss is hit or a re-entry point is hit, we can get back in at very low cost. If you have to crystallize a loss and you have to pay capital gains tax, and you have to pay brokerage and whatever other costs that there are, it makes it even harder. So I can't stress this enough. Please do not cut your position just because you think the market's going to be lower, unless you have the ability to watch markets very, very closely. You have the ability to have a stop loss and a re-entry point. You have the ability to get back in through ETFs as you hit that point, or cut your position, cut your other market point due to a stop loss, and you know that you can do that after costs, after brokerage, after tax, and after anything else that may impact it. Great question. Christine says, if you're really invested in US equities, if taking a long-term view, will you move the funds to emerging markets or you hang in there? Christine, I would say that, again, I'm going to preach diversification. Even though we're underweight the US, it's still about half of our global equity position. So the benchmark's about 65%, we're holding about 50%. So we're 15% underweight the benchmark, but we're still holding half of our portfolio in US equities. So US equities are still a great place to be. It's still the cleanest dirty laundry, if you want to put it that way. Yes, we are concerned about short-term headwinds in the US because profit margins will come down. But longer term, it's a great place to be. Longer term, they've still got some fantastic businesses with great moats. So I wouldn't sell US equities just for the sake of selling them, but I also would certainly consider diversifying into a more balanced portfolio if you only have US equities. If you're already balanced, hold on to them. But if you only got US equities, I think diversification is very important, and it's good to have some of the other themes. In the US has been the only theme that's worked over the last decade, and that's been driven not because of US industrials, not because of US banks, not because of US small caps, not because of US value. It's only been driven by US tech. We've had a very, very narrow breadth to the US rally of the last decade. That theme has worked. Basically, the FANG stocks have been the theme that's worked over the last decade. So it's good to diversify those themes. US equities is effectively your FANG theme, and it's good to have exposure to other themes. And so I would certainly, if you only have exposure to the FANG theme through US equities, diversify and buy some healthcare as a theme, buy some emerging Asia as a theme, buy some value as a theme, or whatever it may be. And so I also forgot to mention earlier on, we don't have our own value ETF. On our balance sheet, on our life license, we've got the Berkshire Hathaway. On our ETF, we've got the UK, the FTSE 100, which we see as a value proxy. And certainly the FTSE 100 doesn't represent the UK economy. So don't worry about investing in the FTSE 100. The FTSE 250 is a dismal performer, and that shows what's happening in the UK economy. FTSE 100 is more exposure to global value and energy. So yes, diversify. Which goes straight into Monica's question: is Sygnia maintaining exposure to UK equities? Yes, we are overweight the UK as a proxy for energy security. So UK has got very nice exposure to gas and oil companies. It's also got exposure to value. So we are overweight the UK in our portfolio. Not only do we have US value, not only do we have global value, we also have our Sig UK, Sygnia Itrix FTSE 100 ETF, which is giving us exposure to value, but also defensive exposure to energy, which we think is going to stay high for a while. Oil prices, I should have spoken about earlier, oil prices have reached the January lows of $85, even lower than $85 a barrel, but we do think that's going to pick up. So we are, by the end of the year, we're probably going to be back to $100 a barrel on oil. So good to have some energy exposure. Dwayne asked a great question about the consensus forecast for interest rates in SA. Dwayne, yes, the FRAs are forecasting a much further. The SOB model is not forecasting anything. It doesn't mean the SOB's not. The SOB looks at a number of inputs besides their model. So the SOB is forecasting more hikes, and the FRAs are forecasting more hikes. I do not think that they are going to. The one-year numbers forecasting nearly another 2% of hikes. I don't think we're going to see 2% of hikes in South Africa. Just as I don't think we're going to see the Fed reaching its peak of 3.5% in US interest rates. I don't think we're going to get there. I think that before we get there, central banks are going to be forced to hike, either allowed to hike because inflation rolls over, which it is doing, or forced to hike because markets remain weak. Shane asked about ESG fund performance. Shane, it really depends on which ESG fund you're in. ESG is such a broad category, and there's so many ESG funds. You can't just, I wouldn't be able to just compare a basket of ESG versus a basket of non-ESG funds. We are launching our Sygnia Sustainable Economy ETF on Tuesday next week, or it's listing on Tuesday next week. There will be a webinar that I'm hosting Tuesday next week, so in 6 days' time. And I'll certainly talk more about ESG and sustainable funds in that webinar. Yes, the Sygnia Life Berkshire Hathaway Fund can be invested through an endowment policy, not through a unit trust, but it is available through an endowment policy. Mervyn asked more about the Sygnia CPI funds. So Sygnia CPI funds, basically we have 4 ranges of core funds. We've got skeleton balanced, which is passive equity, and that's the unit trust. And we've got the skeleton, which is effectively the same on the life license. Both of those, they're basically, we call it all passive, but there is active credit, there's active asset allocation, there is thematic exposure. So they only have passive, only sort of really passive is they have passive equities. But that's your most expensive building block, and that's the one we change. So we have skeleton balance, the unit trust, passive, and we have skeleton on the life license, and then we have the funds which include some active equity. So it's identical, but with some active equity. On the unit trust side, you go from skeleton balance to the CPI range. From the life license, you go from the skeleton range to the signature range. So those that we've got 4 baskets: 2 on the life side, 2 on the unit trust side, and 2 only passive equity, 2 with some active equity, but not all active equity. And that then gives you, and within those, low, medium, and high risk options are available. So if you want unit trust, or you want life license, if you want passive equity, or you want some active equity, or if you want your in terms of your risk budget, in terms of how much equity, we've got the 4 ranges, and within those 4 ranges, we've got 3 to 4 funds. So you've got a full range of funds to choose from. Mike asks if the skeleton 70 fund is appropriate for retirees. That's a very difficult question. I can't answer it. It all depends on what drawdown you need, and how much, basically how much cash you have to pull out of your living annuity, and how much volatility you can absorb. You know, if you have a 2 to 3% drawdown rate, skeleton 70 is great. If you've got a 8 to 9% drawdown rate, then you want to be an income maximizer. So it all depends on your level of drawdown in terms of what you can afford. Basically, you want to be able to, you want your dividends and your income to fund your drawdown where possible, and not to have to live off capital. Once you have to live off capital, then you need to be worried about drawdowns. Yes, you can spread your capital drawdowns over 20 years. That's fine, but make sure it's very, very well spread out over your future time horizon. Good question. S&P 500, we are in a bear market. Yes, it did reach 25% but from its peaks. How low could it go? Could go much further if the world really hits its trouble. But that said, and this is what gives me comfort. We have had bear markets that are much worse than the current bear market, but there's always been a fundamental imbalance, either on the corporate balance sheet or the retail balance sheet. Right now, consumers and companies are incredibly healthy. There's no imbalance, and that means that yes, interest rates slow down growth. Yes, interest rates slow down spending, but those consumers and corporates can recover very, very quickly as soon as the interest rates start to stabilize. You get what is called a balance sheet recession. Balance sheet recession is when there's an imbalance in corporate and consumer balance sheets, and that's what we had in the Great Financial Crisis. So that can take decades for those balance sheets to repair. We're not in a balance sheet recession. We're in an income recession, and that's something that can recover very quickly. So that means that the drawdown is going to be a lot shallower, yeah, I certainly don't think we're going to go much lower than we have, and I don't think we're going to test the lows of balance sheet recessions. So a bit more bullish than some economists out there. Please give you a view on the Fourth Industrial Fund. Another great question. As I said before, we were probably a bit early. We increased our weight in the Fourth Industrial Revolution Fund about a month ago, because we thought US interest rates, US inflation had peaked, and the core accelerated, which caused Fourth Industrial Revolution and other growth tech to underperform. That has actually recovered slightly since then, and we do think I still, I was early, but I still think that it is time to nibble, or to go overweight, select US growth, and we like our fourth industrial revolution. So yes, I'm positive on it. It's certainly the cheapest it's ever been since that fund listed over 5 years ago, on a price to book basis and a price to sell basis. So yes, you don't buy fourth hour because it's cheap, but it does give some comfort that the margin of safety, which you can't really use on a growth company, but there is a bigger margin of safety than there was in the past. While I don't think interest rates have peaked and inflation still is going to remain elevated, I think that core inflation is going to roll over. So we're overweight fourth hour, and we increased our overweight to it. Shane says we're currently placed in a recession for at least 12 months. So what does that mean for markets? I don't think we're certainly not in a global recession just yet. And the US is in a technical recession, but it's really going to come out of its technical recession with positive GDP growth. The euro still needs to go into recession. China was in a recession, but China's come out of recession. So the timing has meant that global growth is yin and yang to the point where overall, globally, the economy is not in a recession and probably will escape recession. Very low growth, below trend growth, which is enough to cause bear markets. You don't actually need a recession to cause bear markets. Below trend growth is enough. Again, considering that we only go to below trend growth, not a deep balance sheet recession, I don't think markets need to fall much further. Bradley says, has your personal view of crypto changed, or do you hold any Bitcoin? No, my personal view has not changed yet. I do not hold any Bitcoin yet. I am a buyer, but not at these levels. Only if it goes much, much lower will I be a buyer. So no, I don't hold any crypto. I think we're getting closer to the point of the distributed ledger technology being more mainstream, and Web 3.0 certainly is very, very exciting. And all the things where you see functions being built on tokens, I think that the upside is very exciting. But I think we're still a long way away out from that, and so I don't hold any yet. If I did, I'd want to get involved in smart contracts. I wouldn't want to get involved in Bitcoin. That said, Bitcoin is, I suppose, the gold standard of crypto, so I understand why people do hold it. But I think economically, I don't hold gold. I don't hold developed market bonds. And I don't hold Bitcoin. I think all those, it's hard to call Bitcoin a safe haven, but all those safe havens that people run to and are all being distorted by quantitative easing. Clive says you've mentioned the Sygnia Global Equity Fund of Funds to invest globally. Sorry, if I got the name wrong, it's the skeleton Global Equity Fund of Funds that fund. So the skeleton balance ranged 40, 60, 70, and then if you want the same in 100% equity, it's the skeleton equity fund of funds, skeleton Global Equity Fund of Funds. Yes, we do actually try to make this more difficult on purpose. So apologies for our naming conventions. John points out another reason to be worried about the US. Yes, the S&P 500 earns about a third of its earnings offshore. So a third of the earnings are going to be muted because of the strong dollar. So not only are earnings reaching headwinds or facing headwinds, but the translation into a stronger dollar is definitely going to impact S&P. So great point. So another reason to be underweight the US S&P 500. Thank you for pointing it out. So he gives me a great quote from President Xi saying, housing should be living in, not for speculation, and to promote stable and healthy development of the real estate industry. I can't agree more. And even though there are a lot of geopolitical risks around China, and even though it is a centrally controlled government, you have to think that right now the moves that are being made while not properly broadcast and while not involving enough debate, are actually good. They could have been bad. I mean, that's the problem with autocracies. They can be bad, but right now, the moves that are being made are setting China up for some decent medium to long-term growth, setting China up for some decent support for the middle class, and if you're earning real return on your capital there, relative to what's happening to the US, where it seems to be all over the place, or in the UK, where it's all over the place, or Europe, I would put it this way. But when it comes to investing right now, you have to pick which country's faults you can live most with. If you want to invest in Europe, you have to worry about the energy crisis. If you want to invest in the UK, you have to worry about the political crisis. And if you want to invest in the US, again, it's probably more of an inflation crisis there, and the fact that there's too much social spending. If you want to invest in Japan, they're still struggling with aging populations and deflation. If you want to invest in China, it's the fact that it's a centrally controlled economy that's just coming out of a property burst and zero COVID policy. But I like its faults more than I like the faults of other ones, and I think the faults are better priced. Even I don't have an answer to your question, so I can't answer you. And that's it. Okay, great. So today went on a bit long. Sorry about that. But thank you very much, everybody. Thank you for joining. Thank you for the great questions. Let's hope for a positive October. I'll see you all next month.